Good afternoon and welcome. This is Markets, Malts and Machines, and I am Vikram Gore. So, last week in the stock market, would you call it a continuation of the Summer of George or a confirmation of buy the rumors, sell the news? The Biden administration came out with a $2 trillion stimulus plan, but the market still went down. If you knew what's to come and we could see the future, none of us would be here. But then again, here we are. So, let's get on with the show. In today's show, we'll cover three things. One, the difference between a mutual fund, an ETF, and stocks. Second, we'll sample a Cask strength 80 Rattray 14-year-old Scotch. And third, we will talk about a really affordable Porsche. Let's get going. Thank you all for tuning in to listen to our show, and thanks for your feedback. And based on that feedback, in today's show, we would like to cover the differences between a individual stock, an ETF, and mutual funds. Now, this would apply predominantly to the investor category, more so than the trader category, like we talked about in our first episode. But nevertheless, it's a good basis to start from for anybody. So let's take a look. Okay, let's talk about the differences between mutual funds, ETFs, or exchange traded funds, and stocks. Okay. Now, to begin with, you may have heard of mutual funds predominantly through your 401ks or your retirement plans. These are historical funds or historical instruments that allowed you to invest in a particular set of a combination of stocks or bonds or what have you, as designed by the fund. But they had some restrictions that were then overcome by something called an ETF. Now, as the name suggests, exchange traded funds. The mutual funds were not that flexible or liquid, if you will, in terms of your ability to actually trade them. And hence, with the invention of the exchange traded funds, as the name suggests, you could actually buy and sell those funds as if it were a stock. And obviously, stocks are most people know how to buy and sell stocks, but we included this in this comparison for completeness. So let's compare these three across a few dimensions, so you get a sense for what you're getting into, and you can make up your own mind and your decisions on whether to invest in mutual funds, ETFs, or stocks. So we'll start off first with the minimums. Now, um, historically speaking, mutual funds have had minimums in the past, and there are some that still have them. For example, the Vanguard mutual funds have a $3,000 minimum that you need to buy into. So you can't. It's not a question of buying a stock worth, let's say, $100 per share, and you buy 10 of those, you pay $1,000. You need to buy in a minimum 3,000 from a mutual fund perspective. That doesn't necessarily apply to ETFs, or it's lower to none. It's like I said earlier, it's based on a stock price, so or the share price or the ETF, and you can buy it and sell it as if it were a stock or a share on the open market, right? So there are no minimums for ETFs and certainly none for stocks. So moving on from the minimums, let's take a look at the next category here, which is a lock-in time period. Now, I remember back when I started investing, which was about 2000 when I started work in the United States, I had picked two different mutual funds, one that had a lock-in period of 1 year and another that had a lock-in period of 3 years. And that's certainly true for closed-ended funds today, but the open-ended mutual funds don't necessarily have a lock-in period. The challenge with this is obviously you're not able to withdraw your money in that time period without penalties if you wanted to do so. That restriction doesn't apply to ETFs and stocks. As we go through this, you'll start to notice that the ETFs are more or less funds like you can treat them as stock, right? So you'll see them very common, a lot of similarities between ETFs and stock. So that's the lock-in time period. Moving on to the next one, active management. Now, this refers to a portfolio manager who's looking at the investments that are there as a part of the fund, right? So a fund is comprised of several different stocks, bonds, if you will, or ETF, or other instruments that are being actively managed by the fund manager. So mutual funds is where you see a high prevalence of active management, and as a result, you end up paying fees for mutual funds. Could be anywhere from 0.7% to north of 1%. But the point there is that someone is looking at the performance of the instruments within those mutual funds and managing them actively. Now, index ETFs that are tied to a particular index, for example, the S&P 500, the example there is SPY, they have very low fees and hardly any active management. There are other actively managed funds such as ARKK, that is predominantly focused on innovation and newer companies, and I think that is a 0.7% expense per year. So there are some actively managed ETFs. For the most part, any index ETFs are going to be not actively managed and hence have low fees. And stocks obviously are actively managed by their CEOs, but as an investment vehicle, it's up to you to manage them. Let's take a look at the next one, the tax implication. The very nature of mutual funds being actively managed, it means you have a higher chance of capital gains tax as a result of the fund manager going in and out of securities and other instruments in order to actively manage it. Now, that doesn't necessarily apply to ETFs or stocks, predominantly because you only pay taxes on these when you sell the stock or the ETF, and if you've had a gain. So until you sell, you don't pay taxes. Whereas mutual funds, if you're going to hold them for 3 years, you may end up keep paying capital gains taxes every year, depending on the activity managed by the fund manager. Okay, so moving on to the next category, which is control on price. Now, this is where the flexibility for ETFs is really great, because what happens with mutual funds, the price for a particular fund per share, if you will, is calculated at the end of the day. So the visibility and the control on price as to when you buy it and when you don't, you don't have as much of a flexibility that you would with an ETF, because just like stocks, ETF pricing is real time. So you get to see when you buy it and it's instantaneous. Okay, repeatability. Now, when it comes to investing small amounts on a regular basis, a consistent basis is the best approach in order to dollar cost average. And as a result, the ability to repeat transaction and consistently invest in your portfolio is critical. That's something that's offered by mutual funds. You can put it in a repeat timer, if you will, and it works. With ETFs and stocks, you have to manually buy them on the open market in order for you to kind of replicate the cadence that you may get from a mutual fund, right? But I mean, those are the main differences, if you will, across the three. Obviously, some of the examples when it comes to each of these three. There are different types of funds within mutual funds. You got a money market, you got equity funds, you got index funds. Now, these index funds will be very similar to the ETFs, nevertheless, not as flexible as the ETFs may be. Looking at some examples for ETFs, the first one is SPY. It's one of the oldest ETFs, and it's indexed to the S&P 500. So essentially, the way the 500 stocks within Standard & Poor's 500 move, the ETF is supposed to kind of mirror that move. So if you buy SPY, if all those, overall the 500 stocks go up, your ETF will go up. Okay. Similarly, IWM, which is a small cap ETF, essentially it tracks the Russell 2000. This has been on fire lately because of the reopening trade. And then QQQ, which is the NASDAQ related tech heavy ETF, which was a big trade in 2020. And obviously, examples for stocks everyone knows. I've got three there: Apple, JP Morgan from the financial services, and Disney from an entertainment services, right? So those are the different considerations you want to think about when thinking of mutual funds, ETFs, and stocks. ETFs are fairly popular these days, just from a consistency and flexibility and ease of use standpoint. We hope you like this conversation and we hope you like this discussion. Please leave your feedback on the comment section. Be happy to answer questions. So let's move on now to the next segment. So, in keeping up with the Speyside region and the cask strength type of scotch, let's take a look at my favorite bottler, or at least the one that got it all started for me, the 80 Rattray. I picked this one up this past weekend from Total Wine. It's the Craigellachie Distillery 14-year-old. Why don't we pour some and find out for ourselves? Now let's look at the color. It's a beautiful copper red, and the nose. The bottle says the nose is a mix of toffee, honey, and slight smoke. I think it's just an indication of all the good things to come when you actually taste it. So why waste any more time? Let's give it a taste. This is one of the reasons why I love Scotch, and especially cask strength. It's the complexity you get from just one small sip of something like this, and the lingering finish afterwards. You can always read out what's written on the bottle, but the taste you get and the experience you feel is always your own. Hope you enjoy it. You can pick it up at Costco. It costs just a bit above $100, but save it for that special occasion. You won't regret it. Cheers. Welcome to our machine segment. After our last week's episode where I quote unquote said an affordable Porsche, I got some hate mail. People telling me $46,000 is not necessarily affordable. So we decided to talk to you today about a really affordable Porsche. Let's take a look. So now we'll take a look at this Porsche Cayenne 2012 base model offered at $21,000 on cars.com. And like I said, this is a really affordable Porsche, but you have to be giving up something to get something, right? So you're looking at this, it's at 78,000 miles. So needless to say, it's not a low run car. Now, as I said in the previous episode, Porsches are meant to be driven long, and mileage tends to be one of the lesser known concerns with Porsches compared to other luxury cars. My car itself actually has about 117,000 miles on it, and it's going fine. So if the mileage doesn't scare you off, and you're not into getting the latest and the greatest in terms of technology, but at the same time you wish to go for a car that's you're going to love to drive and a brand name such as a Porsche, it's available for you at about $21,000. This is a exterior blue color, tan interior, not bad mileage. Actually, I'm surprised at the low mileage here. My GTS, which is a V8, gives me better mileage than this, but it's a later version. Anyway, so moving on from there, you scroll down. There's very limited information on this from the dealership itself. But when you look at this price comparison tool, now some websites will have these, others may not. Now, this is based on similarly priced vehicles in the market, right? So, two things to think about here. One is that's what the offering price is or the list price is. This is not comparing it to what the actual sale price was. Nevertheless, it's comparing this car to similar cars with mileage, models, and makes on the market today, and it's saying that it's fair price, maybe slightly over what it should be. But that's something you can always negotiate. You can use this with the dealership and say, hey, this is what it's saying. And by the way, it can start lower than what you want to get at, right? So that negotiation is up to you. But certainly, if you pay $1,000 more here, it may or may not be that bad given how badly you may want this car, right? So, when you think about consumer reviews for this 12 Porsche Cayenne, I mean, everything is 5 out of 5 stars except for the value for the money, obviously. But you're taking care of that by buying an older car, used car, and paying only $21,000 for a car like this. So this is an option for you. Like I said, it's a really affordable Porsche. Today, if you go on the market, you could afford to get some mid-level car, a mid-size car on the cheaper side for $21,000. But imagine you enjoying this drive for the same price in a Porsche. That is our show for today. Hope you enjoyed it. Please leave your comments, questions, and suggestions in the comments box below. Make sure to subscribe if you haven't already. And if you'd rather email us at marketsmaltsmachines@gmail.com and follow us on Twitter, handle Markets, Malts, and Machines. Do let us know how we can improve the program going forward, including the format of the show. We'd be happy to incorporate. Have an excellent week. I'll talk to you soon.